SEI Investments Company, ticker SEIC, just dropped their Q2 2026 earnings, and we are looking at a massive beat on core operating metrics paired with a headline GAAP miss. Revenue hit $641.6 million, up 15%. Adjusted EPS surged 38% to $1.66, and guidance holds strong for the rest of the year.
Yeah, but that GAAP EPS officially dropped 11% year over year down to $1.59, which absolutely tripped up trading algorithms and caused a super choppy stock reaction right out of the gate.
It is wild to watch. But that is exactly what we are unpacking for you today on this deep dive, because it's practically an accounting illusion.
Oh, it really is. I mean, you have a business posting record-setting growth and expanding margins across almost every division, yet the official GAAP net income number looks like a step backward.
Right.
It is a textbook example of why you have to strip away the accounting noise to see the underlying cash generation of a business.
Exactly. So our mission for you today is to isolate that core operational growth, look at the specific segments driving these numbers, and, evaluate the massive operating leverage the company is demonstrating.
Yeah, and to understand that 11% drop in GAAP EPS, we just need to look at what happened 12 months ago.
Right, the FOS sale.
Yep. In the second quarter of 2025, SEI recognized this massive one-time realized gain. It was $94.4 million from the sale of their family office services business, or FOS.
Which is a huge chunk of change.
It is. And that single event heavily inflated last year's GAAP net income. So when you remove that windfall from the baseline, you expose the true operating performance of the ongoing business.
The way I think about it, imagine selling your house last year and parking the cash in your bank account.
Okay.
This year, you look at your total deposits, and they're lower because, well, you don't have a second house to sell.
Right, you're out of houses.
Exactly. So on paper, your net income dropped.
Yeah.
But if you look closer, your actual salary from your day job, which is your adjusted operating income in the analogy, just went up by a massive 36%.
Yeah, you are in a fundamentally stronger financial position, even if the top-line deposit number implies otherwise. The day job is thriving.
Right.
The underlying business is generating significantly more cash than it was a year ago. Now, Q2 2026 did have a few minor tailwinds of its own, to be fair.
Like the co-investments.
Yeah. The quarter benefited from $7.5 million in gains on LSV hedge fund co-investments. Net of non-controlling interests, that comes out to about $5.4 million.
Okay.
They also logged another $4 million in mark-to-market gains on additional co-investments. But honestly, when you look at the sheer scale of the overall revenue jump, those are just rounding errors.
Just a drop in the bucket.
Exactly. The 38% surge in adjusted EPS is driven overwhelmingly by the core operations scaling up.
So the top-level story is margin expansion and core growth. But, a consolidated earnings report can hide a lot of sins in the individual divisions.
Oh, absolutely.
SEI operates through 4 main segments, and the growth dynamics here are incredibly varied. Let's look at where the actual demand is coming from, starting with the heavyweight, the investment manager segment.
Yeah, this segment is absolutely carrying the quarter. Revenue in investment managers was up 17% year over year to $227.6 million. But the revenue was only half the story.
Right, the profitability.
Exactly. Operating profit jumped 25% to $91.6 million, which pushes their operating margin up to a stellar 40%.
A 40% margin on a $227 million revenue base. I mean, that implies an incredibly sticky product.
Very sticky.
They are converting 40 cents of every dollar straight down to operating profit. And looking at the sales momentum, this segment led the entire quarter with $32 million in sales events.
Yep.
About half of that came from new client wins, heavily influenced by 2 major relationships they announced last quarter.
And the underlying catalyst for that $32 million sales events is probably the most critical data point in this entire report.
Which is?
The presentation explicitly notes that approximately 75% of those investment manager sales events were associated with alternative investment mandates.
Wait, 75%?
75%.
3/4 of the demand is flowing into alternatives. That perfectly mirrors the broader macroeconomic shift we are seeing across the financial sector right now.
It really does.
Traditional long-only equity mutual funds are bleeding outflows, while institutional capital is just flooding into private equity, private credit, hedge funds.
And the thing is that capital rotation requires entirely different infrastructure.
Right.
Traditional mutual fund accounting is highly automated, it's standardized. But alternative investments are a completely different beast. You are dealing with complex capital calls, Intricate waterfall fee calculations, illiquid asset pricing.
It's a mess to track.
It's a huge mess. Plus, you have highly customized reporting requirements for limited partners. Most asset managers just do not have the internal plumbing to handle that at scale.
So they outsource the back and middle office to SEI.
Exactly.
As managers scramble to launch private credit or private equity vehicles to capture that institutional demand, SEI is basically standing there selling the shovels for the gold rush.
That's a great way to put it.
They provide the necessary infrastructure, and because the complexity is so high, they can command premium pricing, which drives that 40% margin.
Yeah, it positions SEI directly in the path of the highest growth area in asset management. Now, moving over to the private banks segment, we see a different kind of margin expansion playing out.
Okay, let's look at the banks.
Revenue in private banks increased 11% to $156.8 million, which is solid, but the operating profit skyrocketed 39% to nearly $31.7 million.
Wow, a 39% jump in operating profit on only 11% revenue growth. That indicates a structural change in how they are servicing these clients.
Definitely.
They aren't just adding new banks to the roster. I mean, they are extracting significantly more margin from the existing revenue base.
Yeah, and that structural change is the migration of clients from their legacy Trust 3000 system over to the modern SEI Wealth platform.
Ah, the platform migration.
Right. Trust 3000 is this older, mainframe-based technology. Operating it requires more manual intervention, more legacy support, and it just generally carries higher overhead. The SEI Wealth platform is their modernized, unified infrastructure.
And migrating a bank's entire wealth management back office from a legacy mainframe to a modern platform is a brutally complex process.
Oh, it's painful.
It takes years of parallel processing, client handholding, but once that switch is fully flipped, the economics change overnight.
Exactly. The modern platform automates vast amounts of middle office processing, so it allows the bank to operate with a smaller headcount, while SEI simultaneously reduces its own servicing costs.
So it's a win-win.
It is, and that dual efficiency is exactly what produces a massive 39% leap in operating profit. It is the delayed payoff of years of technical debt resolution.
Right.
Past sales execution and these grueling implementation cycles are finally translating directly into current financial performance.
Which is great to see. And we see a similar theme of expanding profitability in the investment advisor segment, right?
We do.
Revenue there was up 30% to $177.8 million, making it the highest percentage growth of any division.
Yeah, though we do have to put a little asterisk on that 30% top-line growth.
Because of Stratos.
Exactly, because a significant chunk of it is inorganic. SEI closed the acquisition of Stratos Wealth Holdings back in December of 2025.
Right.
Adding an entirely new firm to the books is naturally going to pad the revenue numbers. Plus, overall market values are higher than they were a year ago, which automatically boosts their asset-based fee revenue without them having to lift a finger.
Sure, the rising tide lifts all boats. The top line is undoubtedly inflated by the Stratos acquisition and the broader market tailwinds.
Right.
However, if we strip out Stratos entirely, just to evaluate the organic health of the core advisor business, the profitability metrics are still exceptional.
Oh, yeah.
The report highlights that excluding Stratos, advisor margins increased by over 300 basis points year over year.
And to put that in perspective for you, a 300 basis point expansion means their core profit margin grew by a full 3 percentage points, ultimately hitting 42%.
Wow.
So even without the shiny new acquisition, the baseline business of providing technology and investment solutions to independent wealth advisors is becoming significantly more lucrative.
Which brings us to the glaring anomaly in this earnings report.
Yep, the holdout.
Across managers, banks, and advisors, we're seeing double-digit revenue growth and massive margin expansion. But then we hit the institutional investor segment.
Right.
Hold on, I'm looking at the breakdown here, and this looks like a massive red flag. If every other division is firing on all cylinders, why is the institutional segment completely stalled out?
That's a good question.
Revenue was up a microscopic 1% to $69.7 million. And operating profit actually shrank by 2% down to $32.8 million.
Yeah.
Given the massive institutional demand for alternatives we just discussed in the manager segment, are they somehow losing their actual institutional consulting clients?
The contrast is definitely stark, but the management commentary suggests this isn't a symptom of client attrition or some broken business model.
Okay, then what is it?
The flat revenue and the slight contraction in operating profit are the result of deliberate, active investments in leadership and sales initiatives within that specific segment.
So they're essentially suppressing their current profit margin to fund a turnaround.
Exactly. They are hiring new sales directors, revamping the go-to-market strategy, and basically incurring those expenses today in hopes of kickstarting growth tomorrow.
Got it. The cost of doing business when you need to ignite a stagnant division.
Right. And it is important to contextualize that 2% profit drop. Even with the increased spend on sales infrastructure, the operating margin for institutional investors is still an incredibly robust 47%.
47% is still huge.
Right. It was 48% a year ago. So they have the financial cushion to absorb these strategic investments without impairing the broader enterprise.
Okay, that makes the flat revenue a lot less terrifying. So the present segments are broadly healthy, with institutional actively funding its own turnaround. But, the market is forward-looking.
Always.
A massive Q2 is great, but we need to know if this is a temporary spike or a sustainable trajectory. For that, we have to look at the sales pipeline and the operating leverage.
Yeah, let's examine the net sales events. During the second quarter, SEI brought in $43.5 million in net sales events.
Which is actually a sequential step down from the first quarter. Q1 was an absolute monster at $67 million in sales events.
It is a step down quarter over quarter, that's true, but you really have to view it cumulatively.
Right.
That $43.5 million from Q2 brings their year-to-date total to an impressive $110.6 million. In the press release, CEO Ryan Hick provided some crucial context for that number.
What do you say?
He pointed out that generating $110 million in sales events over just 6 months would have represented a record full-year performance just a few years ago.
That's crazy. Doing 12 months of record sales in half the time is the definition of accelerating momentum.
Absolutely.
And a massive portion of those Q2 sales events, I think $32.6 million to be exact, are recurring. They aren't one-off consulting fees.
No, they are ongoing platform and processing fees. They are stacking highly predictable compounding revenue into the base.
Which serves as the perfect transition into operating leverage, which is arguably the single most important metric for any technology-driven financial firm.
Oh, 100%.
When a company rapidly scales its revenue, you generally expect expenses to scale up right alongside it. The ultimate goal, the holy grail of corporate finance, is to decouple the two. You want revenue to grow significantly faster than the cost required to generate it.
And SEI is executing that decoupling flawlessly right now. Just look at the consolidated numbers. Total revenue grew by $82 million year over year, but total expenses only grew by $33.6 million.
Wow.
They are capturing the vast majority of every new dollar as pure profit.
It proves that the years of enterprise transformation SEI has been communicating to the market are actually yielding tangible results. Their historical sales and those painful platform migrations we discussed earlier are successfully converting into highly profitable revenue. They're scaling the business without requiring a matching explosion in headcount or server costs or administrative overhead.
Yeah, and as a result of this massive leverage, their consolidated adjusted operating margin hit 32%, which is a full 5 percentage point increase from Q2 2025.
A 500 basis point margin expansion at the enterprise level is massive.
It really is.
When your infrastructure is largely fixed, every marginal client you onboard flows almost entirely to the bottom line.
Yep.
Which naturally leads us to the final piece of the financial puzzle. When a company has 32% margins and is generating massive amounts of free cash flow, how is management allocating that capital?
Well, the cash generation starts with the asset base.
Right.
Assets under management, or AUM, hit $606.7 billion, representing a 17% increase year over year.
Right.
And client assets under administration, or AUA, reached $1.4 trillion, up 20%.
Having $1.4 trillion in assets under administration gives them a massive, stable fee base.
It's huge.
And within the assets under management, we definitely have to highlight the performance of LSV Asset Management, which operates as a critical growth engine within the SEI ecosystem.
LSV had a phenomenal quarter. They generated $2 billion in net inflows, driven almost entirely by the funding of a massive new client mandate.
Wow, one client mandate.
Yeah, and when you layer those $2 billion in fresh flows on top of strong market appreciation across their existing portfolios, total LSV assets increased by nearly $17 billion in the second quarter alone.
And because LSV's underlying investment performance was strong, they triggered performance fees, right?
We sure did.
The earnings report shows $17 million in performance fees generated for the quarter, with roughly $6.5 million of that flowing directly to SEI based on their ownership stake.
So you have a $1.4 trillion administration base and a $600 billion management base constantly throwing off cash. SEI ended the second quarter with nearly $400 million in cash sitting on the balance sheet. So management has to make a critical decision. They could hold the cash, they could initiate another acquisition like the Stratos deal, or they could return the capital to shareholders.
And they opted for the latter,
Yeah.
aggressively repurchasing their own stock. The report notes they used their strong cash flow to buy back 1.3 million shares of common stock for $112.4 million.
Yep.
The average price on those repurchases was $86.92 per share.
Share repurchases are a highly efficient mechanism for returning capital, particularly when management believes the market is undervaluing the core operating leverage of the business.
Exactly.
By repurchasing 1.3 million shares, SEI reduced their total outstanding share count by roughly 3%.
The best way to visualize a stock buyback, love this analogy, is to think of the company as a large pizza.
Oh, yeah, the pizza analogy.
Right. The total size of the pizza, which is the overall value of the company, that hasn't changed. But management just bought back 3% of the slices and threw them away.
Or ate them.
Right, ate them. Point is, the remaining slices instantly become larger. You own a bigger percentage of the same company.
Exactly.
Mathematically, even if SEI's net income stayed completely flat next year, their earnings per share would still go up because those earnings are being divided among fewer shares.
But their net income isn't flat.
No, it is growing rapidly due to the operating leverage we just discussed.
It creates a powerful compounding effect. You build out the complex infrastructure to handle alternative investments. You endure the friction of migrating banks onto modern platforms.
Right.
You lock in recurring revenue. You hold the line on expenses to drive massive margin expansion. And then you use the resulting flood of free cash flow to shrink the equity base.
It's brilliant.
It heavily rewards the shareholders who understand the mechanics beneath the headline numbers.
So, to synthesize this entire Q2 2026 report for you, SEI is not a company struggling with an 11% drop in net income. That is an accounting phantom tied to the sale of a business a year ago.
Yeah, total noise.
The reality is a company undergoing a highly successful strategic transformation. Operating discipline is paying off in real time, heavily rewarding shareholders through a combination of 500 basis points of margin expansion and aggressive stock buybacks.
The headline numbers present a paradox for sure, but the underlying cash flows and segment metrics operate with incredible clarity.
Absolutely. And I want to leave you with one final thought to ponder as you look at the broader landscape of the wealth management industry.
Okay, what is it?
We noted earlier that a staggering 75% of the investment managers' sales events were driven by alternative investment mandates. Historically, private equity, private credit, complex hedge funds, these have been the exclusive playground of institutional capital.
True, but the walls around those asset classes are beginning to fall.
Exactly. The industry is aggressively pushing for the democratization of alternative investments, attempting to expand private markets directly into retail and retirement channels.
It's a huge shift.
It is. If everyday retail investors suddenly have access to institutional-grade private credit and equity, the processing volume is going to absolutely explode.
Oh, for sure.
So is SEI positioned to be the primary toll collector for this massive financial shift? They clearly have the institutional plumbing built.
Right.
Or will servicing millions of retail accounts in private markets require entirely new, massively expensive infrastructure investments that will drag down those pristine 40% margins?
That is the multi-trillion-dollar question for the wealth management industry, and SEI is standing right at the epicenter of it.
They really are. And if you want to keep unpacking the mechanics behind the numbers with us, make sure to follow the show for our daily earnings coverage.